The Book on Advanced Tax Strategies. Chapter 7. Playing keep away from the IRS using the 1031 exchange. A 1031 exchange is when you sell a real estate investment property and buy another one that is like kind. An example of an investment property would be a rental property that generates passive income or a farm that generates income from selling crops. The reason that people want to do a 1031 exchange is because you don't have to pay taxes on the sales proceeds. This essentially lets you upgrade to a bigger property without incurring any taxes. There is a time requirement, however. There is a 45-day deadline to identify a replacement property. The property must be equal to or greater in value to the one being sold. Another option is to identify multiple properties, a maximum of 3, that has a total purchase price equal to or greater than the one being sold. Once identified, you have 180 days to purchase it. If you attempt to do this strategy and fail to meet the time constraints, all that happens is that you have to pay taxes on the purchase price. Buying a bad property so that you meet the time requirements is never recommended. Chapter 8. 1031 Exchanges Gone Wrong. There are many ways a 1031 exchange can go wrong. I will include a list of mistakes that people have made in the past when attempting to do this strategy. Number 1. Investing proceeds into a syndication. Membership interests of an LLC or a partnership are not eligible. Number 2. Not meeting title or ownership requirements. If you directly owned the property sold, then you must directly own the property being purchased. Number 3. You must work with a 1031 exchange intermediary. If the profits from the sold property are deposited into your bank account, you are no longer eligible. It must be held by a third-party exchange intermediary company. Number 4. Not purchasing a property for the same or greater value as the sold property. Number 5. Buying a property that costs more than the taxes you would have saved. Number 6. Purchasing a bad asset that costs you money, time, and stress. There are many things that can go wrong when doing a 1031 exchange. The best practice is to be proactive and ensure that everything is set up before you start the selling process. Also, speaking to a tax expert is crucial.